Key figures. A quick and easy way to analyze the development of a company. A key figure analysis can provide a brief overview of a business, its valuation, and its condition. Key figures or key performance indicators simplify the picture of external accounting. The following video includes the formulas for calculations and brief explanations for some key figures related to liquidity, solvency, and profitability. They can be used, among other things, to compare two companies in the same industry, such as between H&M and Zara in the clothing industry. Liquidity. Short-term ability to pay. The difference between money in and money out. Working capital. The capital to finance the day-to-day operations. It can also be used to see how well debt is used to create growth. It's equal to current assets plus unused checking credit minus current liabilities. Quick asset ratio. Shows how well short-term debt can be paid. At least 100% is usually desirable. Excludes inventory. It's equal to current assets minus inventory plus unused checking credit divided by current liabilities. Current ratio. Nevertheless, the ability to pay in the short term. The guideline is at least 200%. Includes inventory. It's equal to current assets plus unused checking credit divided by current liabilities. Solvency. The financial strength within the business. The ratio between total and equity capital. Equity to asset ratio. This shows how much of the total capital in the business is made up of equity. It's equal to net worth divided by total assets. Interest coverage ratio. How well the company can pay its interest-bearing debts. A ratio of at least 1 should be achieved, as fewer means that the company makes a negative result after financial items. It's equal to operating profit plus financial income divided by financial expenses. Debt to equity ratio. A measure of the relationship between debt and equity. Can be used for an estimate of the business risk. It's equal to adjusted liabilities divided by adjusted equity. Profitability. The company's financial success. The ability to generate returns. Return on total capital. The ratio shows how well the business creates a return on the total capital. The measure is very industry specific and it's suitable for measuring companies within the same industry. For example, the average within Sweden, property management excluded, is slightly higher than 10%. It's equal to operating profit plus financial income divided by average total capital. Du-Pont. Return on total capital. Measures profitability by comparing profit margin against the asset turnover ratio. Profit margin. A measure of how much profit is created based on revenue. It's equal to operating profit plus financial income divided by net sales. Capital turnover. The rate of capital turnover shows how long capital is tied up in the business and how efficiently it is used. It's equal to net sales divided by average total capital. Together, they add up to the return on capital, ROA. Return on capital employed. It shows how profitable a business is based on return on debt and equity. It's equal to operating profit plus financial income divided by average capital employed, which is shareholders' equity plus interest-bearing liabilities. Return on equity. before tax. A measure of profitability for the owners that shows how well their invested capital is returned. It's equal to net income divided by average shareholders' equity. Finally, an example of a formula that can be used to compare the key figures related to profitability and solvency, the leverage effect. This formula shows how the business uses debt to increase the potential for returns. With a combination of the business profitability, interest rates, and degree of indebtedness, it's equal to ROE equal ROTC plus ROTC minus I times D divided by E. With other words, return on equity equal return on total capital plus return on total capital minus average cost of debt times net debt divided by equity. For more videos, please subscribe. If you like this video, make sure to check out the next one. Thank you.